2.6%. That is the number everyone is fighting about. Europe is flatlining, but Goldman thinks the U.S. is about to sprint.
And that number, that 2.6%, it really is the single biggest bet in the global economy right now.
It is.
If you dig into the latest Goldman Sachs macro outlook, I mean, they're calling for this sturdy global growth of 2.8% in 2026. That's well above consensus.
Way above.
But that whole story, the idea that we dodge a recession and actually accelerate, it all hangs on this one idea of U.S. exceptionalism.
Exactly. Goldman's got U.S. GDP at 2.6% for 2026. The rest of the market is stuck down around 2.0%. They're betting we don't just defy gravity, we lap everyone else. We've got their research right here, and I'm taking the bull case on this. I see the tailwinds, I see the fiscal rocket fuel, and I see the structural reasons the U.S. is just fundamentally decoupled from the rest of the world right now.
And I have to be the necessary bearer in this room, because if you look just one layer deeper, past that headline GDP number, you see these structural cracks. And Goldman, to their credit, they point them out.
They do.
They call them primary risks. And for me, it's the disconnect, this growing chasm between a rosy output number and what's actually happening in the labor market. We have to be really careful not to confuse a temporary sugar high with sustainable growth.
All right, let's start with the bull case then, because the optimism is real, it's powerful, and it's very front-loaded. Goldman's call for the U.S. to jump from 2.1% this year to 2.6%, it's based on a very specific cocktail of policy and market momentum.
It is entirely front-loaded. That's the key thing to remember. They see real GDP spiking to a, frankly, massive 3.5% annualized in Q1.
Huge number.
And then it slows down after mid-year. So if that initial spike doesn't happen, the whole forecast kind of falls apart. So what's driving that sprint?
Okay, so we have three key impulses giving the economy a boost. And the first one, funnily enough, is actually a negative. It's the fading of a major headwind.
The tariff drag.
Exactly, the tariff drag. If you look back at last year, that 11 percentage point increase in the average tariff rate, it took a solid 0.6 percentage points right off of growth in the second half of 2025.
That's a heavy anchor to be dragging.
It absolutely was, but you assume those tariff rates just stabilize in 2026 and that drag just vanishes. The economy gets out of its own way. You remove that anchor, you basically add back half a point of growth without doing anything else. It's a mechanical lift right off the bat.
Okay, getting out of your own way is one thing, but you need actual momentum. Where's the new money coming from?
That brings us to impulse number 2. The massive fiscal kicker from the One Big Beautiful Bill Act of 2025. This is stimulus hitting everyone at once, consumers and corporations. On the consumer side, we are talking about an estimated $100 billion in net tax refunds, just hitting bank accounts in the first half of 2026.
$100 billion, that's about 0.4% of disposable income, all at once. That is a serious jolt.
It is. It's pure consumer confidence fuel. And then for businesses, the bill shifts back to full expensing for CapEx.
Right, so they can write off big purchases immediately.
Immediately. Instead of depreciating them over years. It makes big investments way more attractive now, and you can already see that reflected in the forward-looking indicators.
I will grant you that fiscal impulse is undeniable, especially hitting early in the year. But let's stay on the consumer for a second. If you're a household and you're looking at a labor market that feels a little soft, which we'll get to.
Okay.
Are you really spending that entire refund check?
Yeah.
Or are you maybe saving a good chunk of it as a buffer? The whole bull case relies on high consumption, but people might be more cautious.
That's a fair point, but look at the timing. That money hits in H1 just as the third impulse is peaking. Easier financial conditions.
Fed cuts, credit access.
Fed cuts, easier credit, some deregulation, and just this general market euphoria around AI. All that together is estimated to add another 0.3 percentage points of boost, peaking right in Q1. So you combine the fading tariff drag, the stimulus checks, and cheaper money. And suddenly that 3.5% skew sprint looks entirely plausible.
Okay, that is the bull case. A triple-cylinder engine running hot for 6 months. But here is this central painful contradiction in the entire forecast. This is the pivot point that could send us spinning: the labor market. I mean, the job market outlook, in Goldman's own words, is less inspiring than the output numbers.
Okay, so if the economy is growing at 2.6%, spiking to 3.5%, why isn't the job market keeping up?
It's the productivity paradox. It's happening in real time, and it is deeply, deeply tied to technology and AI.
Right.
We are seeing this undeniable productivity acceleration, partly from AI, partly from optimization. And what that does is it fundamentally raises the bar for how much GDP growth you need just to create a single new job. If every worker is suddenly 5% more productive, You need fewer people for that 2.6% growth.
So the U.S. economy is getting stronger but less inclusive.
Precisely. And look at the data points they're citing. In the U.S., unemployment rose from 4.1% in June to 4.6% in November. That's a material jump, 0.5%, while we were supposedly seeing solid output. That trend, that upward creep in unemployment, that is the canary in the coal mine. You can't just dismiss it.
So is this it? Is this the AI recession people have been whispering about?
Not yet, but the forces are aligning. Right now, the immediate AI impact is mostly in the tech sector itself, where, employment's already been weak.
Sure.
The real risk isn't today's numbers. It's what management is planning for tomorrow. And this part is fascinating. Managers surveyed by GS bankers, they expect material headcount reductions over the next 3 years.
That's the real forward-looking risk then. It's not about the Q1 stimulus check. It's about the structural change that's now baked into corporate planning.
It is. So more labor softness is basically a certainty. It doesn't matter how fast Q1 grows.
Yeah.
The core macro tension here, the whole reason this is a risky forecast, is that you're trying to balance this narrative of high growth, which is propped up by temporary factors, with a labor market that's simultaneously softening.
Right.
If that unemployment rate touches 5%, all the recession fears come flooding back. And then the Fed is forced to cut, not because inflation is dead, but because the jobs market finally cracked.
That's a huge domestic risk. But even if the U.S. does slow down in the second half, Goldman still sees the global picture holding up at 2.8%, which means we have to talk about China. Their manufacturing engine is a massive piece of this global story.
China is a massive, complex, and frankly, a potentially destabilizing factor.
Goldman's got them at 4.8% growth for next year. That's above consensus. And it's driven almost entirely by their industrial sector. Their ability to just make quality goods cheaply for export is unmatched. We have to remember the scale of their control over supply chains. 90% market share in magnet production and rare earth refining, 70% in rare earth mining. That kind of control doesn't just drive exports, it gives them enormous geopolitical.
And that powerful export engine is the precise source of the drag on everyone else. You cannot separate China's manufacturing strength from its domestic weakness.
Okay, go on.
While their factories are humming, their domestic economy is profoundly weak. Property sales are down 60%. Starts are down 80% from the peak. That's acting like a dead weight, dragging an estimated 1.5 percentage points off their own GDP.
So they're solving their internal demand problem by just pushing all that industrial overcapacity out into the global system.
As cheap exports. It's the definition of a beggar-thy-neighbor policy.
Right.
This mix of strong manufacturing and weak domestic demand is pushing their current account surplus to a record high. Goldman thinks it could hit almost 1% of global GDP by 2029. And where does that surplus go? It swamps international markets. And that supply surge weighs heaviest on competitors like the euro area, specifically Germany.
And when you look at the euro area, it's the clearest counterpoint to U.S. exceptionalism you could possibly find. It's a picture of structural weakness just being hammered by that Chinese competition.
It's so structurally challenged. The data is brutal. You've got demographic decline, you've got crushing overregulation, and you have domestic energy costs that are just orders of magnitude higher than in the US, Japan, or China. That energy PPI chart is just staggering.
All the structural issues drag their underlying growth trend down to just 1.0%, less than half the US estimate. Europe is flatlining. It's the divergence story in a nutshell.
But even with all that, Goldman is a little more optimistic than the street, forecasting 1.3% growth. So they are seeing some pockets of resilience. It's not a total collapse.
So where are those pockets?
Two places, mainly. First, fiscal stimulus in Germany, which, despite their reputation for austerity, is coming from off-budget infrastructure and military spending.
A necessary counterweight.
And second, strong consumer spending and diversification in Southern Europe. They single out Spain, which is seeing 3% real consumer spending growth, and is actually doing a decent job diversifying into higher value-added services.
So the euro is bruised, but not broken. We have the U.S. sprinting, China exporting, Europe limping along. If we tie this all back to policy, the whole positive story really depends on inflation cooperating, right? Giving central banks the cover they need.
And Goldman is convinced it will. They expect developed market core inflation to fall pretty smoothly toward target. For the U.S. and U.K., they see core slowing from around 3% down to just a little above 2% by the end of 2026. This disinflation trend is the oil that greases the gears of the whole bull case.
And in the U.S., what are the biggest levers pulling that number down? Is it just rents finally rolling over?
It's two big things. First, yes, shelter inflation. That OER metric, owner's equivalent rent, is finally set to decelerate as the earlier crash in market rents flows through the official data. That's slow, but it's inevitable.
And the second lift.
The second, and maybe the more important one for the Fed, is wage growth. It's slowed to below that estimated 4% sustainable rate that's consistent with 2% inflation. And since so much of services inflation is tied to labor costs, that should keep the disinflationary momentum going.
But wait, what about the tariffs? You said they'd cause a short-term inflationary pop. Does that not derail the whole thing?
No, because it's just a temporary distortion.
Okay.
You're right. The pass-through could add up to maybe 0.8 percentage points to inflation by mid-2026, but then you run into favorable base effects.
Right. Year-over-year comps.
Exactly. So that big impact just diminishes really sharply in the second half of the year. It's noise that the Fed can and should look right through.
And all of this progress on inflation gives the Fed the cover it needs to address that softening labor market we talked about. Goldman's calling for 2 25 basis point cuts in 2026.
50 basis points total, taking the funds rate down to 3.25%. And they see the risks as clearly skewed dovish. This is a key insight. The cuts aren't just a victory lap on inflation. They're driven by those labor market concerns. A cooling jobs market gives the Fed the perfect political cover to ease policy a bit.
Which is a huge divergence from Europe. The Fed's cutting while the ECB is expected to remain firmly on hold.
Absolutely. The policy paths are diverging as wildly as the growth forecasts. And it's interesting, Goldman also disagrees with market pricing elsewhere. They think the markets shift to expecting hikes in Canada, Australia, and New Zealand. They see that as premature.
So let's pull all these threads together. Better growth, lower inflation, a cutting Fed. What does this benign baseline actually mean for risk assets, for investors?
In general, it's friendly, especially for equities. And here's why there's room for upside. The market has priced in some good news, but it's still pricing U.S. growth much lower, around 1.7% for Q4 2026. Goldman's at 2.5%. If Goldman's right, there is significant room for cyclical upgrades to push stocks higher.
Okay, that makes sense for equities. So from a portfolio management view, what are the specific allocation insights?
Equities are favored globally.
Yeah.
And the case for diversification is strong. They expect emerging markets and Japan to perform quite well, even outside the U.S. story.
But credit looks like a bad bet.
Correct. The risk-reward just isn't there. You're seeing companies re-leveraging, and you have this enormous demand for capital issuance driven by the AI boom.
Everyone needs cash for data centers.
Exactly. And that's likely to cause spreads to widen, at least modestly. So we'd expect credit to underperform.
What about fixed income? Do we still need bonds if the Fed's cutting?
The total returns will probably be range-bound. They will make you rich. But, and this is crucial, short-term U.S. rates exposure is an absolutely necessary hedge. It's your primary protection against that recession fear, the fear that the labor market cracks and the whole thing comes undone.
So you need that short-term duration.
You do. But they caution against longer-dated German and Japanese bonds.
Let's end on the biggest, most structural risk here, which really ties back to where we started with productivity. AI. AI has been a much, much bigger story for markets than it has for the actual economy so far.
It is the valuation tension that keeps me up at night. The market is incredibly vulnerable here because equity valuations, particularly in those AI-related names, the Magnificent Seven and their peers, have already built in significant benefits from future AI adoption. The market is traced in the sprint, not the marathon.
The risk being disappointment. Disappointment over the pace of innovation or maybe the pace of monetization, when the revenue actually shows up.
Or, and this is more subtle, what if the value just needs to be reallocated? Right now, all the money is with the infrastructure providers, the chip makers, the cloud companies. What if the real economic benefit ends up with the users of AI? Those high valuations just make the market acutely vulnerable to any downside surprises. The whole thing could pop.
So what we have is a dramatic divergence, an uneasy equilibrium. You've got this seemingly robust U.S. economy built on temporary fiscal support and fading drags, but it's running alongside a soft labor market that's keeping the Fed dovish. And meanwhile, a structurally challenged Eurozone is facing this massive competitive pressure from China's export machine. It's a world running at two completely different speeds.
If Goldman is right, the euro is dead. But if they're wrong, the U.S. market has a long way to fall. Let's see who blinks first.